So Amy is lecturer in economic geography at University College London, and she has a PhD awarded by Queen Mary University London. And the talk she's going to present today is called The Financialisation of Care, Investment Funds and the Sustainability of UK Care Homes. So a really critical topic at this very challenging time for the world of care and caring. So absolutely delighted to invite you to share with us some of your research findings and thoughts, Amy. So please go ahead when you're ready.
Fantastic. Thanks very much, Sue and Kelly, for helping to organise as well. But yeah, I'm delighted to have the opportunity to share with you some of my research, particularly such a kind of vibrant group of researchers. And I'm really glad that people from beyond could join thanks to this kind of digital transfer. So yeah, I'm sorry not to be with you in person, but really appreciate people finding the time to join amid all the other pressures that people are facing. So today I'm going to be drawing on some published work and some newer material that is currently under review, and really look forward to your questions and comments on it. So as Sue says, I'm an economic geographer. I'm interested in the interactions between finance, labour and care. I've done research on these themes in the UK and the US, but my talk today is going to focus on care homes for older people, which provide assistance with daily life and in some cases nursing care to more than 400,000 residents in the UK. So the need for an effective and resilient care system has been made more starkly evident than ever by the devastating impacts of the current pandemic. So Kelly, next slide, please. So I wanted to start with a quote from one of my interviewees who works for a trade union. And here she is describing a set of new care homes that were built by a private equity-backed company in England in the 2010s, which replaced several publicly run care homes. So she said, they're like hotels, really. They're all very nicely furnished. But the reason it's nicely furnished is that they've cut carers' wages by £2 an hour, so they can afford to do it. They are much better, I'd say. Whether the residents feel that, I wouldn't know. It's not very cosy. When I say hotel, I'm probably talking about a travel lodge. It's comfortable, but honestly, when you're in one, you wouldn't know which one you're in. They're all so similar. And the company made this huge thing about how they've got cinemas. Well, I've never seen anybody in the cinema. Usually that's where they shove us from the union when we go and visit, because nobody ever uses it. So I want to consider kind of why we're seeing this style of care homes being built, which is perhaps not fully responsive to residents' needs and is being accompanied by cuts to labour costs. Next slide. Thanks. So over the next 40 minutes or so, I'll be arguing that the undervaluing of care helps to explain the proliferation of specific forms of ownership and business strategies among major care home companies. And these have made the sector more fragile, less sustainable in several respects. So sustainable funding for care isn't merely a question of reversing austerity, but it requires us to consider how providers are structured and where resources flow or don't. The consequences can be analysed in terms of employment conditions, the built environment for care, and access to good quality care services. I'm going to start by outlining my theoretical framework and introduce my main argument, and then I'll explain my research methods and go on to answer these questions. So in what sense are care homes financialised? Why has that occurred? What are the impacts and what are the implications for policy? Next slide. So conceptually, I draw on the political economy of finance and literature on financialisation. So financialisation can refer broadly to the increasing importance of financial markets, institutions, and motives in the world economy. The rise of finance since the 1980s has been linked to post-industrial economy's search for alternative sources of growth, to the development of huge pools of investment, for example, from pension funds, and to a shift towards deregulation and a greater policy emphasis on using finance to manage risks. Within corporations, financialisation involves a stronger emphasis on returns to investors. Among care homes, investment funds, such as private equity firms and hedge funds, have come to exert a strong influence as owners through the use of specific sources of finance and approaches to realising returns from care companies. Such investors have sought to release value from property assets, converting them into tradable financial securities. However, that conversion can be difficult because diverse properties are difficult to quantify and compare, given specific local markets, for example. So to simplify that process of conversion into liquid financial assets, to reduce the risks that accompany it, investors work to define and standardise real estate developments. So what does that mean for the built environment of care homes and how it might be experienced? Next slide, please. So that approach can also be combined with feminist ethics of care. Care ethics challenge the neoliberal model of subjectivity on which care policy is largely based in England, and suggest alternative propositions for social relationships. So care ethics understand subjects as interdependent, embodied and emotional, and care as requiring responsive relationships. In terms of the built environment, Imrie and Coleman have argued that design should support the precarious attachments in bodies, materials, and spaces, and should convey relational values guided by ethics of care. Indeed, existing research suggests that a homely physical environment and strong relationships are key factors for quality of life in care homes. So I think that care ethics offers us a valuable framework for evaluating the infrastructural and relational spaces produced by financialisation. Next slide. So these are the key arguments that I'm going to be making. So first of all, that the undervaluing of care has facilitated financialisation. It's enabled the expansion of extractive, risky business models by creating a privatised sector with limited democratic influence over the use of assets or employment standards. And that creates additional pressures that are absorbed by carers and residents. One specific way in which that is manifested is in the built environment. So investors seek to rationalise and standardise spaces of care. Rather than care homes being responsive to the situated knowledge and embodied needs of carers and residents in line with ethics of care. Standardisation helps to reduce the work of translating the built environment into liquid financial assets, but then increases the work of creating relationships and a sense of home in such environments. So the labour kind of gets shifted from investors to care workers and residents in that sense. Who are these spaces designed for? Well, they tend to be designed for tenants who are themselves liquid, that is financially solvent and able to move to the increasingly centralised large-scale care homes. But on the other hand, caring relationships constrain and can destabilise financialisation by inspiring resistance to financial discipline and by being embedded rather than transferable or liquid. The next slide, I set out my research methods. So I drew on analysis of corporate data. So corporate filings for care companies going back to the early 90s when we first started to see private equity come into the sector. Then data from real estate investment trusts looking at their portfolios in 2016 and 2019. And reports from industry bodies and property brokers like this one shown on the slide. I also interviewed 25 different actors, a combination of investors and industry advisors, care staff in different capacities, and trade union officials. So any insights into the environments, activities and relationships come largely from care workers' perspectives. They were able to draw on experience in different homes and comment on changes over time. And I've also drawn in this research on some data from the Care Quality Commission, which creates reports based on observation and talking to residents, among other data sources. But I haven't interviewed residents of care homes for this project. That wasn't part of the kind of original project design. And of course, there's issues with informed consent with those who have advanced dementia. So instead, I'm relying on the perspectives of care workers. For example, one nurse sort of said that residents were unable to comment on the redesign of a care home, but she believed that she could see that they had symptoms showing greater kind of instability after that redesign. Next slide. So firstly, to what extent is the sector financialized? And using that in the sense of these this ownership by particular investment funds. So, of course, the government remains an important funder for care services in the UK and in England, paying at least part of the cost for the majority of residents. But ownership of care homes is overwhelmingly in the private sector, perhaps 95%, according to Knight Frank. Care homes are highly diverse, and overall the sector is quite fragmented. So most are run by small-scale private operators. Then you've got a couple of larger voluntary sector organisations among the top 10. But the large private chains are owned by financial investors, which have been willing to take on significantly higher levels of debt for acquisitions, capital spending, and expansion, compared to more risk-averse shareholders in publicly listed companies. So this slide shows a snapshot of ownership, tongue twister, from 2015, when 7 of the 10 largest care home chains were owned by investment funds, accounting for approximately a fifth of the sector. Next slide. So why has this type of financialization occurred? Well, the reliance on private capital reflects a deficit of public investment. And that goes back to the design of the post-war welfare state, when there was no full public responsibility taken for social care and a means test set up to access it. It's intensified with the restrictions on capital spending that were imposed as conditions of the IMF emergency loan to the UK in 1976, and has since been further entrenched through policies promoting the privatisation of care, as well as austerity, which, as you know, has been kind of, to a considerable extent, devolved to local authorities and having a strong impact on social care. Meanwhile, the regulation of providers through the market oversight system was a deliberately light touch option set up to oversee provider finances following the failure of the leading chain Southern Cross in 2011. So I think that lack of public investment reflects the low status of care workers, residents of care homes, and of care work itself. As in this, kind of memorably titled work by Joanne McGregor on Zimbabwean migrant cleaner carers in the UK. So I'm sure most of you are familiar with the literature. Indeed, many of you are authors of the literature on care as being constructed as an unskilled form of work, as dirty work or body work, to be performed either informally or by a non-professionalized workforce. It's overwhelmingly done by women and disproportionately by Black and minority ethnic staff and migrants. So a report commissioned by the private equity industry, which was published in 2012, noted the low level of opposition to privatisation of social care services, which are largely provided by unqualified, low-paid staff, compared with a high level of political opposition to privatisation of healthcare services, which are largely provided by professionally qualified staff. And of course, there's much to say about the construction of the value of older people and care home residents, but particularly often seen as a burden on the economy. So against that context, there's been kind of an influx of private capital. So at the same time as we've seen a lack of public investment, there's been a glut of private capital from institutional investors, such as pension funds, in search of investment opportunities, especially those linked to property assets that offer rental income and capital gains. And these have contributed to high levels of debt financing available through relatively deregulated capital markets. Next slide, please. So I want to examine two key types of investors, some of their ways of realising returns and the risks involved, before turning to their impacts on staff, on the built environment, and access to good care. So one key type of investor has been private equity firms, which buy other companies using a combination of their own capital, others' investment, and high levels of debt. So they aim to restructure and expand the company, typically within 3 to 5 years, before selling it on at a profit. Their use of debt financing, rather than relying on investment from shareholders, has offered tax advantages. But the debt costs can be high and repayments can be less flexible during a downturn or a period of difficulty for the company compared to equity financing. Moreover, private equity firms often impose complex corporate structures on their portfolio companies to minimize tax payments and liabilities of them as ultimate owners. So any of you who have looked at the report by Diane Burns and colleagues will have seen the phenomenally complex structure of Four Seasons Care, with dozens of related companies, many of them located in tax havens. So overall, this approach can incentivize very highly leveraged buyouts and the overexpansion of companies, which can be left with unsustainable debts, while diverting revenues towards investors and away from other actors, including tax payments to government. So to take the case of Four Seasons Care, it was first bought by a private equity firm in 1999, expanded considerably in the early 2000s and sold on in 2004. Just 2 years later, there was another acquisition of Four Seasons, this time for £1.4 billion, so more than nearly double its value when it was sold 2 years earlier, much higher ratio of its earnings. And that deal was almost entirely debt financed. So once the financial crisis hit, the company really struggled and required an £800 million debt restructuring. This is described as one of the largest in Europe, caused by the financial crisis. So new private equity owners acquired the company in 2012 for, as you can see, substantially less than that 2006 figure, promising new and more stable financing. But that didn't really pan out. Still in 2016, Four Seasons had 13% of the debt across the residential care sector, compared to only 5% of its beds. So disproportionately high level of debt, which was unaffordable. In 2017, it failed to make a £27 million interest payment on time, and its largest creditor, a US hedge fund, effectively took control. So efforts to find a new buyer for Four Seasons have failed. The Financial Times recently described it as the business no one wants, and the company has been being broken up, with homes transferred to new operators. And at least 23 of those homes that are being taken over by other companies have been shut down. So, and I'll talk more about the consequences of care home closure a little bit later. Next slide, please. So as in other property-intensive sectors, investors have sought to unlock value from care homes as real estate. And isolating those aspects of the business has been made possible by sale and leaseback arrangements, in which properties are legally separated from the care service business. The properties can then either be used as collateral for loans or sold off and leased back to the care operating company. So that offers investors a straightforward financial route to profit. The capital that's unlocked from the sale of the property means they can quickly recover their initial investment and retain the option to buy the care operating company if it proves profitable, but with minimal further risk. So, as one investor said, sale and leasebacks from a financial engineering perspective can be phenomenally accretive. You can get all of your money back on the property company, and then you have a call option on the operating company, the actual care business, and just hope that it works out. It was bad, but it's exactly what Blackstone did with Southern Cross. They bought it, sale and leaseback, took all their money back, and it blew up, but they didn't lose anything. So aside from the moral issues there, they can be incredibly good uses of your balance sheet. So he described how throughout the 2000s, lots of care homes were acquired by landlords who kind of used a high degree of debt to buy them, but then struggled to maintain their repayments during the financial crisis. And so he was kind of contesting the claim that it was down to austerity that these companies or these landlords were struggling, and said it was a question of their, as he put it, over leveraging and skullduggery. Next slide, please. So as these private equity owned companies have struggled with over indebtedness, other actors have become more prominent as investors in the care sector, and in particular, real estate investment trusts, or REITs. So REITs issue publicly traded shares to investors and pay dividends based on their rental income and capital gains from their property portfolios. They've been permitted under UK regulation since 2007 and further deregulated in 2012 when more international participation was allowed. So with strong demand for property investment and a favourable tax regime, they've been able to raise cheap capital. And indeed, they became the major investor in UK care homes by 2018. In 2016, US-based REIT Welltower was the largest single developer of care homes in the UK. And these REITs started off by kind of concentrating their interest in wealthier areas, particularly in the southeast of England, looking to snap up the kind of prime care home chains. But subsequently, the kind of limited supply of that prime part of the market and high land costs in those regions has seen them spread out across a more diffuse geography. So in addition to their role as developers, REITs have acquired existing care homes and are an increasingly significant landlord in the sector. So looking at their portfolios back in 2016, there were 5 REITs active in the sector, and they owned about 260 homes. By 2019, that had grown substantially. There were now 9 REITs in care homes, with a portfolio of 467 care homes, so an 80% increase in 3 years. So as a rough estimate of how many people might be living in REIT-owned care homes, we could say about approximately approaching 30,000. As well as acting as developers and landlords, REITs play a third role as lenders to their care operating company tenants, or to finance leveraged buyouts of care chains by private equity firms. And this is part of a spreading of property investment beyond traditional commercial real estate to alternative sectors, including care homes, hotels, and student accommodation. So these were expected to provide consistent counter-cyclical returns based on longer leases than those that were being taken on by other commercial tenants. And this has, been a big story in property investment in the last few years. In 2017, 28% of commercial property investment in the UK went into this alternative part of the sector, including 8% to healthcare, which includes care homes. And care home REITs have generated high returns. For example, Target, which is based in the tax haven of Jersey, offered investors a 35% return over 2014 to 17. Next slide, please. But despite REIT's promise of low-risk financing for care infrastructure, there's several ways in which this model of care home development brings risks to the homes of potentially a large number of elderly people. So first, REITs have tended to charge care homes substantially higher rents than other landlords. That reflects the cost of new developments and also investors' expectations of strong returns. So one property broker told me that care homes that were renting from REITs would typically be paying 15 to 20% higher rents compared to other landlords. And REIT leases typically include annual mechanical upward-only rent reviews, so giving operators limited flexibility if they hit difficulties. As a result, care homes renting from REITs often pay a larger proportion of their profit as rent. And high rental costs drive care companies' efforts to maximise the fees that they charge to residents, which can deepen inequalities of access and also divert resources away from residents and staff. So in addition to returns from high rents, investors in REITs can benefit from capital gains as their real estate assets rise in value. Portfolios are typically revalued twice a year, and increases in value tend to be reflected in the share price. So these arrangements can contribute to asset price inflation. Among UK care homes, highly capitalised REITs engaged in what one investor described as a buying frenzy in the early 2010s, acquiring homes at ridiculously high multiples of the company's earnings that wouldn't have been possible if capital costs were higher. So this investment professional summed up the approach of most REITs as buy it, don't care how much you have to pay for it, just show me the rent, lovely, bosh, done. So by 2014 to 15, property investors observed that American REITs were the primary driver of increasing values in prime healthcare assets, including care homes in the UK. Where property assets are leveraged, debt imposes higher costs on operators and potentially puts the sector at risk in a downturn. And then a third risk relates to lending. So as I said, REITs can lend to their tenant care companies. Some of those debts have proved unsustainable. For example, the American REIT HCP has made a major loss on its 137 million debt financing for the buyout of Four Seasons back in 2012. With the spread of COVID-19, care home REITs share prices have plummeted, as this figure shows, and credit ratings agencies issued negative outlooks for the debts of several in recent weeks. Some, however, appear to be relatively stable and are continuing to pay out to investors. So it remains to see kind of how exactly the impacts of the pandemic play out across different parts of the sector. Overall, though, treating care homes as liquid financial assets and residents as a source of revenues to be maximised can generate more exclusionary, risk-laden landscapes of care. Next slide, please. So I want to look at some of those impacts in more detail now. So alongside value extraction from care companies' property assets, owners have made continuous efforts to reduce the share of revenues going to labour rather than creditors, landlords and the investment funds themselves. The heightened pressures imposed on companies have been partly absorbed by investors' ability to exploit distinctive characteristics of the care workforce and service users, as well as the nature of care work. So when the first private equity firms entered the care sector in the early 90s, they went further than previous private operators in reducing labour costs. And that reflected their need to meet heavier financing costs and achieve high rates of return to their investors. So this was a kind of step beyond privatisation as it had taken place beforehand. Indeed, one investor described the dominant feature of early private equity deals in the sector as the opportunity to, quote, get the labour costs down by 30%, in large part by reducing staffing levels and wages. And those kind of initial cuts to labour costs have been deepened subsequently alongside rising financing costs and rent bills. So I think it's important to remember that those changes represent a substantial deterioration in the terms and conditions for a workforce that is largely working class, mostly female, disproportionately Black and minority ethnic. Care workers' wages are low, even in financialised homes with mostly private clients, even though they have the benefit of high fee income and not so much cross-subsidy of publicly funded residents, according to investors, staff and unions. So on the one hand, you have this kind of narrative from investors and from the regulator that these changes can happen, quote, without noticing an impact, and that they offer local authorities value for money. So I think this concern for cost rather than staff retention reflects the low status of the non-professionalised workforce. And of course, care has one of the highest rates of staff turnover of any sector in the UK economy. In contrast, care ethics understand care as co-produced by staff, residents and other actors, and dependent on the relationships between them. This perspective recognises that the interactive nature of care means that staff and consumers are intimately related. So pressure on one group heightens the vulnerability of the other. So for example, after cuts to sick pay that were introduced following a private equity buyout, some carers said they were compelled to work when unwell, despite the vulnerability of residents to infection. And of course, we've seen serious issues with that very recently. Personal knowledge of and sustained relationships with residents are also important to good care, but they can suffer with staff turnover. So the reorientation of corporate resources towards financial actors also comes at the expense of residents' bodies and well-being. These changes can take advantage of the limited mobility and capacity of many residents, which, contrary to the model of the neoliberal consumer, makes them unlikely to transfer to another home if care is poor or if fees rise. Indeed, for private clients, fees have been rising above inflation at a rate of 4 to 5% a year, according to investors. But those services, despite the high fees, can still be under-resourced in ways that are dehumanising for residents and demoralising for staff. For example, care staff reported management pressure to ration basic supplies such as incontinence pads, as in this quote, even in a care home that had a high proportion of staff paying at private fees of £75,000 a year. Next slide, please. So investors have also been reshaping the built environment for care. Investors categorise care homes as a subsector of commercial real estate alongside hotels. And that helps to render them comparable to other properties and calculable as investments. One established investor described care homes as a variant of hotels, just needs a bit more care for the inmates. So this categorization as an alternative property investment alongside hotels helps to reduce investors' sense of risk by offering an alternative use for the space. If profits fall too low in residential care, some homes, what one investor described as the new Holiday Inn Express type unit, could be converted into low-end hotels or student accommodation. And we also see this in care company marketing materials that emphasize that the facilities are hotel-like or hotel standard. So I don't think there's any sense of particularity of place or of the material and relational character of home. Care staff contended that a hotel-like place is not a home-like environment. And they also described design as following abstract templates, unresponsive to the embodied needs of residents and the situated knowledge of staff. For example, a new facility built by a company under private equity control had 4 wings accommodating 15 people each. But staff described the homogeneity of design as disorientating for residents with dementia. They'd suggested that the wings could have different designs, but they hadn't been listened to. And instead, they ended up with this kind of alienating environment, disorientating environment. And in that context, extra labour is required by residents and workers to create a sense of place and home. Care standards can also come under pressure as a result of investors seeking to increase profitability by reducing care staff costs and achieving economies of scale. So new homes now tend to be significantly larger. However, care staff said it's very hard in a 60-bed home to get to know the people as well as in a 30-bed home. So reductions to staff terms and conditions, like in the example that I opened with, can exacerbate staff shortages and turnover. And these pressures can undermine caring relationships and a sense of community. Next slide, please. A further issue is that the framing of care homes as hotels influences the pricing of services with implications for access to care. The costs for accommodation and food in a care home are commonly referred to in the sector as hotel costs, separate from the cost of care services. By charging premium hotel costs, investors are leveraging the vulnerability, immobility, and relationships that tie residents to particular places. In that sense, care is embedded, it's not liquid. Fee revenue is most lucrative in the case of privately paying residents, and investors have become increasingly focused on this market in the context of austerity. For example, Ventus REIT has aimed to have 90% self-funding residents compared to the sector average of 40%. But the exclusionary cost of care has resulted in underoccupied homes, even as the older population has been growing. So that underperformance further threatens the stability of the care sector. In addition, investor imperatives can result in the de facto eviction of residents in at least 3 scenarios. First, residents of some homes can be forced to leave if they exhaust their wealth and become unable to pay the fees. Second, homes have been strategically closed where local wealth was not sufficient to supply the desired proportion of privately paying residents. As one investor in a major care chain said, we've always got to churn the estate to make sure you put in at the top and slice off at the bottom. And third, home closure can occur as a result of financial difficulties that arise from risky investor practices. As many of you will know, the most dramatic crisis in the sector came with the collapse of the major chain Southern Cross in 2011. So its properties had been sold off, leaving care homes with rising rent bills. As financial pressures have mounted, the company had cut spending on the physical environment to the extent that several homes had been run down to rack and ruin, according to a former carer, and they were shut by the regulator, so their residents were forced to relocate. More recently, as this newspaper article shows, closures have continued on a significant scale in the crisis hit 4 seasons. So through care home closures, financialisation can effectively lead to the eviction of some of the most vulnerable members of society. Relatively mobile capital induces a forced mobility among less powerful actors. The distribution of revenues to investors and creditors is prioritised over redistribution to support those needing care based on relations of interdependence and responsibility. Moreover, home closures can destroy relationships among carers and residents based in particular homes. They can place a strain on relatives and friends if residents move to a new home at a greater distance from their community. And the relocation of care services can require staff to commute longer distances. In contrast, ethics of care strongly values those relationships and recognises that they're situated in place based on interpersonal knowledge. Next slide. However, it's important to recognise that investment funds control only a minority of the sector. And so we need to identify what's constraining this expansion of this form of financialisation. Over recent years, efforts to find buyers for each of the 4 major care chains, even the most profitable, have repeatedly failed. So I think there's several reasons that we can identify, and one of those is to do with the care workers and their approach. So while, as Diane Burns and colleagues have shown, carers absorb some of the financial pressures on care companies, they can also resist some of that financial discipline. So despite being reprimanded or threatened by managers for overspending on supplies for residents, staff reported frequently prioritising care over those budgetary considerations and fighting with management on behalf of residents. Then another constraint on profit margins and the expansion of companies owned by investment funds comes from the labour intensiveness of interactive care work. So investors reported that it's very difficult to reduce wage costs in care homes below around 60% of company revenues. Some of them have squeezed them down, but they face lots of problems. So care's labour intensity deters the continued expansion of companies, even where there's financing available to finance that. So despite the benefits to investment managers of increased company size and economies of scale, large care companies actually tend to experience diseconomies of scale, according to industry sources. For example, as Southern Cross grew rapidly under private equity ownership, investors and care staff reported increasing complexity, poor communication, and falling care standards. And as a result of these problems, investors reported increasing cautiousness about company expansion. And then finally, although the undervaluing of care has facilitated privatisation and some of these high-risk financial practices in the sector, it's also limited the resources within the sector that are available for extraction by investors. So with pay for care workers so low, companies have become unable to make further cuts to wages without breaching the legal minimum in many cases. And highly constrained public funding for care has also been limited as a source of greater returns to investors. Next slide, please. So to conclude then, I think the standardisation of these care developments challenges some of the claims in recent literature of increasing policy and data-driven personalisation. Instead, we're seeing this kind of mass production of space by what Martin and colleagues have called Taylorist finance. And we also see that trend, I think, in some purpose-built student accommodation and some purpose-built short-term rental developments. So here, theories of care and sociocultural geographies of home provide vital tools for critique, recognizing the importance of embedded relationships and responsiveness to embodied needs, including through the built environment. Standardizing real estate assets, as I've said, reduces the work required to transform them into comparable liquid financial assets. And then the work of mediating between markets and particular places is shifted to those who use the spaces, who have to do more to transform them into homely places reflecting particular needs and to compensate for a loss of features that can support relationships, such as shared spaces. So I think further research is needed into how residents, relatives, and workers perform the work of making home and forging relationships within these kind of hotelified, liquid real estate developments. So as we consider how to build a safer, fairer care system, clearly space for care needs to be more prominent on the agenda. Long-term secure land tenure on an affordable basis is essential for care homes and other spaces of care. Care facilities need sustainable financing for capital expenditure on new developments and for major refurbishments. And land and finance have to be available to care providers such as cooperatives that operate without high-risk gambles on financial markets. Progressively funded spending in the sector promises to create good low-carbon jobs, as well as upgrading care settings to tackle emissions from the built environment, so contributing to a green recovery from COVID. Spending on care supports both workers within global care chains and local foundational economies. However, democratic control of spaces of care presents particular challenges given the health conditions and short lengths of stay of many residents. So the ownership, governance, design, and work in care spaces requires genuine co-production involving residents, the wider community, relatives, workers, volunteers, and local government. And I think in line with care ethics, that reflects a more distributed concept of agency grounded in interdependence. So thank you, and